How to achieve optimal asset allocation? What is the best way to allocate assets? What portion of your portfolio to invest in different asset classes? Answer to all these questions lies in understanding the logic behind asset allocation. We have investment expert Sadish Prabhu with us. Could you please explain the logic behind asset allocation?
There is also what I call as a correlation. A correlation is what you call as matchmaking. So when somebody gets married, we normally check the horoscope and we check, whether things match, and what we say there are, 36 things to be matched is what, 32 or 36. I don't know the exact number, but the number of things to be matched is very important when marriages happen in India. So similarly, when you look at asset classes, the term used is correlation. It has to have a low or an inverse correlation for it to give you a balanced return. So, for example, large cap equity and small cap equity or mid cap equity, since they all fall within equity asset class, they will have a similar correlation, or they will have a higher correlation. But I told you that equity and gold are opposite sides of that table, and that's why they have a lower correlation. Lower to negative correlation is a better fit for asset allocation, and I'll just show you a few numbers. And we have already spoken about rotation of outperformance. When we saw that sometimes it's equities, sometimes it's gold, so no asset class can give you consistent returns. So there is always a rotation of the best performing asset class. So these are some of the characteristics that you ought to keep in mind. Now, I spoke to you about risk and returns. And here you have the three famous asset classes: equity, debt, and gold. Now, let me first talk about risk. In this case, while equity has given you higher returns, you can see that it has fluctuated the most. And in 2008, between 2019 and 20, and after somewhere around 21 and 22, you'll observe that equities have fallen a lot. And the fluctuations in equity are a lot more compared to gold or compared to debt. So that is what I meant by the risk that you take. But if you are willing to take that risk, then equity can give you much better returns. So in a period of 20 years, equity has given you almost 18% returns. And I'm talking about the Sensex. If you look at some of the mutual funds, they would have given you returns more than 20%. Similarly, gold, while it has given you around 12% returns, the returns are lower. But if you observe, the fluctuation in returns is also lower. But it is not as low as debt or bonds. If you look at government bonds, 10-year government bonds, they have given you only 6% returns. But if you do not want to take any risk, you will end up getting lower returns. So you have to take some amount of risk between equity, gold, and debt to come out as a winner. So that is the difference. So this is the reason I showed you this graph, that while returns are high, you have to be ready to accept the fluctuations in equity to a large extent. And I spoke about matchmaking. I spoke about horoscope. Now, these are the correlation numbers. So one is where if the number is 1 or above, the correlation is very, very high. So when the correlation is high, the diversification is lower. So when I say your asset allocation is only between large cap, mid cap, and small cap, it may not be a good asset allocation. The reason I'm saying is that you have invested in very highly correlated asset classes. that means your horoscope is not matching. But if you tell me that I have invested in equity and debt, and the where the correlation is very low, it is 0.09, then I will say yes, it's a good asset allocation. The horoscopes are matching. If you bring me equity and gold, it is further good because the correlation is negative. Negative is opposite, and that's the reason you found equity and gold on the opposite sides of the table, because they have a negative correlation. So here the horoscopes are matching much better between equity and gold, and debt and gold is also good because they have a negative correlation. But low to negative is something that is good, and that is why we always say that you should invest in equity, debt, gold as a combination for asset allocation. So remember, I don't want you to know the numbers. The numbers could be technical, but remember the horoscope that I spoke about and the matchmaking. So the horoscope will match when it comes to equity, debt, and gold because they have a low to negative correlation. So remember that. Do not put all your eggs in one basket. Do not put everything in equity. Do not put everything in gold. Do not put everything in debt because they have the same correlation, similar correlation.
Thanks for your detailed answer. If you have any questions related to this or any other investment options or related to your financial goals, feel free to book a free appointment with our financial planner. The link to the free booking is given in the description below this video. Also, will you be interested to attend insightful investment webinars? Then feel free to register for our upcoming insightful enlightening investment webinar, and it is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give a thumbs up. Also share it in your social circle. If you are not subscribed to our YouTube channel so far, please subscribe now.